The Federal Reserve has no easy move right now, and markets are starting to feel that tension. The Fed is navigating one of the hardest stretches in recent monetary policy history. On one side, inflation has proven slower to cool than policymakers expected. On the other, the labor market and broader economy are showing signs of strain. That leaves the central bank caught between two risks. And investors are beginning to price in the possibility that officials could be slow to respond in either direction. To understand why this matters, it helps to know what the Fed is actually doing. When the central bank raises interest rates, borrowing gets more expensive across the economy. Mortgages, car loans, business credit. The goal is to cool demand and pull prices down. But if rates stay elevated for too long, while growth is already weakening, the risk shifts. The economy can slow faster than intended, and recession becomes a real possibility. That is the core of the dilemma. Move too soon, and inflation could reignite. Wait too long, and growth could tip into contraction. Neither outcome is good, and right now the Fed does not have a clean path between them. Stock markets are acutely sensitive to this kind of uncertainty. Equities generally perform well when investors believe rate cuts are coming, because cheaper borrowing tends to support corporate profits. When that expected timeline gets pushed back, or when the direction of Fed policy becomes less clear, stocks often pull back as investors reassess what companies are worth. Bond markets are watching just as closely. Any shift in how Fed officials communicate their priorities, how much weight they give to inflation versus employment, can move yields quickly. Investors pass every public statement from Fed policymakers looking for signals, and even subtle changes in language can move markets. For now, the Fed's benchmark rate remains at a level designed to restrain economic activity. Officials have been consistent. They want to see more evidence that inflation is moving sustainably toward their 2% target before they ease policy. But that calculation can shift with each new data release. Jobs numbers, inflation readings, consumer spending figures. Every report adds to or subtracts from the Fed's perceived room to act. That is what makes the next several weeks significant. Upcoming inflation and jobs data will be closely watched, not just for what they say about the economy, but for what they imply about the Fed's next step. The practical takeaway: pay attention to the data before the decision. When inflation or employment figures land in the coming weeks, the market reaction will often tell you which way policy expectations are shifting before the Fed says a word. This briefing is brought to you by First Financial News, clear daily coverage of the economy and markets at firstfinancialnews.com.